welcome to another edition of BullionStar Perspectives. My name is Ronan and Ned from BullionStar in Singapore, and today we're delighted to have on our show Ned Naylor Leyland from Merriam Global Investors, which has been bought out by Jupiter. Hello, Ned. How are you?
I'm very good, Ronan. Delighted to be here and on the show, and I'm willing and able to offer a perspective of sorts.
Oh, we're delighted to have you. And I think it's quite apt that we're starting to the discussion just as the gold price has gone back over $2,000 and silver is over 28. So that must be causing some interest in the institutional community in London.
Well, I think it's creating interest in the institution community globally, Ronan. I think the thing that I can offer about where we are now, which I think is relevant, is that I feel that we're reliving the 70s cycle. It's going to be a lot bigger this time, and a lot of us, yourself, Ronnie, different people, myself, we talked about this a lot for a long time. And my key observation to do with price is that, remember, in the early 70s, gold went up a lot, went I think 3 times, something like that. And then it corrected 50% in a period of disinflation, and it was all going to be fine and all this stuff. And then the back end of the 70s happened. We got falling real interest rates. We got political chaos. And then this is the key point, when gold broke through the previous high that it had marked in the early 70s, that's when it just went straight up. Now, I'm not saying that's going to happen this time, but I do think it's interesting, particularly like the way markets are so momentum driven now, and but the market is like a blob. I mean, there are those of us that sit to the edge of it, but broadly it's a blob. And I think it's very instructive to look back and go, look, last time, it took breaking through the previous high from 6-7 years earlier before you got the real genuine rush. So I think you're right to bring up the fact that we're touching that level again and that we're looking at breaking into genuine new territory, because history suggests that would probably drag material further waves of flow on the basis of marking new highs.
So when you were looking back last week, for example, and the gold price hit an all-time high of, say, 1920, it hadn't previously hit that since August, September 2011. Then it quickly went up to around 2060, 2070. And then we had that sell-off last week where there was a waterfall cascade back down to 1870, I think. We're all pretty much used to those possibilities right now. But I myself thought that it would regain ground quite quickly. And as it turns out, that has happened. Now that the price has gone back up about over $2,000, do you think that is going to attract the attention of everyone, really, media, retail investors, institutions, who will see that the 2000 level was breached on the upside, then on the downside, again on the upside? Is that really clearing the runway for something unprecedented to happen now in the next few weeks?
In my view, definitely yes. And I think the reason is, it's interesting talking to you about it. I mean, obviously we've known each other a long time. We have a lot of similar views about things. I think that it's important to recognize that there are 2 different types of investor who can allocate and would allocate. And one is the SPID, sorry to be rude, and the other is the investor. Now, I don't think the investor is going to be as moved by a two handle, so a change in the dollar gold price like that. But would the momentum-based leverage type investor behave differently based on a 2 handle? Undoubtedly, there's a difference there in the way people invest and whether or not psychological levels matter. But I think what I would also say is that, as you said, you expected a shallow pullback. I wasn't so sure because I was a bit worried about the overall market. It looked to me like it might possibly be another sort of air pocket for markets. I know, most people are expecting that to happen at some point. If that happens, gold will go down, silver will go down short term because they are driven by real interest rate movements, and clearly deflation is bullish for dollars on deposit versus the risk-free, which of course is gold. But I think that what's interesting is that the pullback. So remember that what we had is we had a small rise in real rates that drove gold down, silver down, corrected. And what was it that caused that? Rumors of a Russian vaccine. Now, if you can explain to me how that has anything to do with real interest rates, the monetary or fiscal policy, or anything to do with the yield curve, I'd love to know what it was. And all it was just a breather. You know, the market needed a breather. Real rates had gone so far. Unwind of leverage. You know, a bit of a trading move. It was bid hard, as you said. I don't think we're going to get any kind of meaningful move lower without a deflationary collapse. I think deflationary collapse is still quite likely. And then what matters is another fringe subject you and I are interested in, which is whether Mr. Insider knows something that we don't, and is trying to telegraph that by telling us all about the great freeze up or whatever he calls it. We know what we're talking about here. You know, whether we're going to get some kind of freeze in the system and then a reboot, or whether they're going to go all in with policy again. I don't think it makes much difference for owners of gold and silver. I think the way property ownership titles should be okay. I don't think that's really going to be an issue because the system wants to retain control, and control is going to be a lot harder if individual property rights and stuff are removed from people. So I don't think that's really an issue, but I do think we could go lower in the deflationary lurch. But something helpful for people who haven't heard me talk about this before. 08 was very similar to March, and what I'm talking about is very similar to March and 08. What I'm saying is the same thing. It's a deflationary air pocket. In 08, it took 6 months for the central banks to respond with the policy that drove real rates down and gold up. This time it took them over a month, actually. It took more than a month. It was basically a month. It took them a whole month of like that before they turned around and delivered the policies. Initially promises, but then policies as well. And I think this time the half-life would be commensurate with that trend, so it might be a week. So if we go into another blood-curdling sell-off, the policy response will be much more rapid than it was in March, in my opinion.
So, like even today, for example, I was looking at Twitter and people are starting to come out with tweets talking about real rates falling and the gold price going up. How big is that correlation? And is it something that is really fundamentally driving the US dollar gold price up? Or is it just one of the variables and it's the most obvious and it's the easiest for media commentators to explain?
Well, what fun to talk to you about this. Okay. So I'm going to say it dogmatically and tell you how it is, okay? But you can obviously disregard it and ignore me. But what I've learned is that was the point of creating the LBMA. You know, it was in order to make gold and silver FX/monetary instruments alongside the fiat one. And therefore, yes, the pricing channel is always going to be the biggest one, which is FX. That's where the price discovery takes place. And the sterling gold price, annoyingly, I can't share my screen and show you this, but I have a slide in my slide pack which shows you that the sterling gold price is the inverse of forward sterling real interest rates. The best way to look is about 7 to 10 years out, because of course gold is about holding, not spending. So sterling gold is the inverse of sterling real rates, dollar gold is the inverse of dollar real rates, and so on. So yes, intentionally that changed in the early 80s. It's in order to manage the gold price on a very structural level. So remember that the way they did that between 2011 and recently is a really important thing to understand. How did they get gold down or dollars up and sterling up and gold down, you know, over the course of 7-8 years? Well, the answer is language. That's all it was. Just language. So they managed the situation through real interest rates by using language. So what you do is you say, we're going to do all this stuff. And the bond market goes, oh, that's very exciting. How bullish for the dollar. And it all gets priced in. And that happens. So yes, it's all about real rates until, and you'll recognize this from my Twitter feed, we get, dude, where's my gold? And then game over. And then it's nothing to do with real rates, obviously. But my view is, and I'm going to be forceful about it, I think about 90% of price action is real. And probably 10 is leverage. So it's like, it's real rates and leverage, and that's it, nothing else.
Which brings me to a point that I think you probably have a good view on. Back on the 23rd of March, when there was a price divergence between the US COMEX gold futures price and the London spot gold price, that seemed to trigger a series of events which are still in motion. And from that, I mean, LBMA came out with quite a bizarre statement saying that they were going to support COMEX with delivery obligations. Then, as we saw over the next 4 or 5 months, there were huge amounts of gold going across from Europe, being delivered into COMEX, up to around 700 tons. And that also triggered record deliveries of gold on COMEX. And what I mean by that is record warrants changing hands, these warrants representing gold bars apparently in COMEX warehouses. So in April, June, and now in August, all of these contracts are having record amounts of deliveries. So I see that as having been triggered on the 23rd or 24th of March. And I think personally that there was a failure to deliver in some shape or form connected to the EFP, the Exchange for Physical in London. Do you think that there was in any way a failure to delivery of physical gold, or a failure to allocate unallocated gold in London, which triggered this whole series of events?
Well, the first thing I would say, so I'm going to give you a series of responses. The first formal thing I'd like to say is you definitely know more about this than I do. So I'll give you my thoughts, but I mean, I am not an expert on this. I'm not an expert really on anything. I know a fair bit about everything to do with this subject, but not lots about anything. But what I would say is that there was definitely a problem with either physical or credit, wasn't there? We know that much. I would, if I were you, and not to suggest you should or shouldn't have on your perspective thing, but get my colleague Daniel on. He would have much more insight, having worked in the bullion banks, on this subject. So I would press you to grill him on it and say, what do you think?
Yeah. So, sorry. I've had a few chats with Daniel Marsh, and he will definitely be one of our guests on BullionStar Perspectives in the near future.
Okay, but so to extrapolate a bit further, I think that I'm trying to work out a pitch this on the basis you and I know really very clearly what we're talking about. I think that this is all about the ETFs. So I think that, which maybe not be what you were expecting I was going to say, but that's, for me, it's just all now. We've got to the point now where they're really hanging on by their fingertips now. The system is really holding on grimly. I believe that there's some commonality here with the virus situation, in as much as what is needed is civil disobedience and questioning and probing, and not compliant, supine behaviour, which is what you see broadly. So I think that there is a very important clashing trend here of large money managers that apparently know what they're doing, buying large lumps of what clearly is not what it purports to be, versus those people who are going to go, I refuse to wear the mask into the supermarket, and I'm not going to do that. Now, there is this same tension happening in our market, and we both know what's going to win. The timing of it's very difficult to understand, and I don't know quite how the EFP thing ties into it, but I tend to think it could have been as simple as, your observation, which is there's no float at all, or it's so tiny, and we can see what's coming here. We can see the demand is already appearing in this very short air pocket period. So no metal leaves London. I mean, that would be my sense. But please, push back, because I don't know that much about it.
Well, I think you're right. I think on the 23rd of March or the 24th of March, there was some event which involved a request for delivery, which wasn't honoured by some of the bullion banks in London. And that triggered an announcement by the LBMA and COMEX jointly that they needed to deliver on obligations. And my pet theory is that whoever was asking for delivery couldn't get it, and then says, well, if you can't deliver now, you have to deliver in the future. So they said, we can't deliver right now, but over the next 6 months, we will deliver as much as we can. And what you're seeing now is that those delivery obligations are being gradually honoured through the COMEX 100 ounce contract. And all of that gold was sent over to New York, beginning in April, May, June, July, and August. And all of the delivery obligations are being executed through gradual deliveries in the April, June, and August contracts. And that's quite a wild theory, and I haven't really explained that in any type of articles or blogs. But it's something that is an intrinsic hunch to me. And I think what I probably would need to do is to flesh it out with our friend Daniel Marsh, and then try and put the pieces in order to explain.
Well, I think your basic thesis is very good, because of course it's the same as what the Americans did to the Germans, which is no, piss off. We'll deal with it at our own speed.
Influence, yeah, the Bundesbank and the New York Fed, where they asked for a lot of gold, and the Americans said, well, right now, no, but we can start the ball rolling with 20 tons up at 200 tons in next year, 2013, 14, 15.
And again, you know, there's such a strange thing here. There's definitely a lot of read across to the social environment we're in, and the political environment. Because again, you know, it's so weird what you can and can't do at the moment. You know, none of this makes any sense. Like, you can, like, people are flying in through City Airport with no monitoring, you know, freewheeling, and I can fly here and there, and I can really, everything's possible, but nothing's possible. And it's all a psychological thing. And I feel the gold market is very, very similar. It's all about stay in the water, trust us, we're telling you what you need to hear. And at the margin, it's fraying, and at the margin, people are unwilling to do that because they see the consequences of doing that being potentially quite risky. So maybe we should be poking at this slightly.
I remember back in March and April, drawing an analogy between the 1968 gold pool, which collapsed in March 1968, and the current situation of March 2020. And the fact that even back in December, November 1967, when the London gold pool was trying to keep the price at $35 an ounce, they were selling as much gold as possible. They said, we have a lot of gold, there's no point in panicking. And the markets were testing them, and it was tested in December 1967 and gradually into January, February. And then in March 1968, the markets just overwhelmed the possible supply of gold. They were flying over hundreds and hundreds of tons of gold from the US and military planes to Mildenhall military airport north of London, bringing it all down to the Bank of England. But on that occasion, the lack of physical broke the gold pool. I like to think that there is currently a gold pool, and but it's more of it's hidden, but it's not really a physical gold pool. It's the whole infrastructure.
It doesn't need to be
gold pool, because as you say, the price is dictated by the unit of gold credit. But seeing that you mentioned the London float, for people who aren't aware of this, there is a way of calculating how much gold the London gold vaults may have that is available for anyone who wanted to take delivery. Because like, the main components are the Bank of England gold stocks, gold that's tied up within physically backed gold ETFs, and then everything else. So if you have, for example, 8,000 tons of gold in vaults in London, 5,000 tons of that is the Bank of England, 2,000 tons is ETFs, at least 1,000 tons. But one thing that people aren't really, they don't know anything about is, of that, say there is 1,000 tons of float, you could call it a gross float. How much of that is owned by institutions, ultra high net worth individuals, sovereign wealth funds? Do you have any data on that?
Well, I'm going to argue. So to add to your work and your observations, I would say two things. The first is all of it. So not the banks don't keep. This to be very clear to your viewers. Banks don't keep a single ounce in just-in-time available inventory. It's not how banking works. Let alone how the gold market works. So that would be my first observation. Is I just don't buy the fact there's any. So whether it's 1,000 or 0, but I think the more important point is that it's much worse than the way you picture it, because of course the way you're painting it is that each ounce only has one owner. So in other words, what you're doing is being incredibly generous with your analysis. You're trying to be as generous as you conceivably could be by going, well, you know, let's pretend that all of this is 1 for 1, which is what you're saying. Therefore, it's unavailable, you know. But wait a minute, that's not true either. So it's all a lot worse than that. And I dare say the true state of affairs is very similar to the true state of affairs in politics, etc. In other words, it'll be a great mirroring. The level of degeneracy and moron behaviour behind the scenes will be about the same. You know, when you have no oversight, which, as we know, is our biggest issue. I mean, for God's sake, in lots of areas, these things go on where there is oversight. So, I mean, the idea that you know, we would be accused of, you know, outlandish claims. Well, it's a difficulty we've come across over the decades, I suppose. We're probably used to it now.
I remember that reminds me of an interview which I think CNBC did about the GLD back in 2008. It was a Bob Pisani, and they interviewed the head of precious metals from Barclays. And Bob Pisani brought up the view that maybe the gold isn't all there in the Spider Gold Trust involved in HSBC, and the particular gentleman, the head of Barclays Precious Metals, sort of smirked and says, that would be illegal.
Well, that whole episode merits revisiting and rewatching. And I'm sure you remember me telling you the story, but it's again might be of interest, which is at the time. So even back then, obviously, I was very noisy about don't buy bank issued 1 times long gold products. You know, it's not really a good idea. And 2 days after that interview went out, ETFS came to see me because they'd heard I was a skeptic and and they brought along their crack team, about 5 of them, explained to me why I was wrong and all of this. And I brought up the Bob Pisani interview. And I said, "Did you see that wonderful thing?" They said, "What are you talking about?" I said, "Well, you know."
This is where he held up a gold bar, which he thought was in the Spider Gold Trust, but it was actually in the ETFS.
Well, so the story was this, which is he held up the bar and said, and so in fact what happened was this. He said, "I spent 2 hours with the people who keep the bar list." So you're thinking, what, doing what, playing tiddlywinks? What were you doing for 2 hours? I mean, what a load of absolute nonsense. Anyway, he said that, and then he said, "Oh, and this is what, you know, is held on your behalf." And as you know, he tilted it towards the screen, and people like you and I went, "Bar list." And of course, that bar, despite him spending 2 hours with the bar list, was not on the bar list. So this was the start of my conversation to ETFS, laughing, going, "You know, I know you're here to convince me, but I mean, after the nonsense we saw 2 days ago, you know, it ain't going to work." And the nice lady there goes, "I don't know anything about this. Can you send me the clip?" So I sent her the clip, and she did send me an email back going, "OMG, that's our bar." And we gave no permission for anybody to touch it. And that I just happened to be in the right place at the right time during that story, that I happened to be, like, you know, weirdly in the middle of it.
Lynchpin.
But I mean, it just shows you the whole thing is banking, Ronan. You know, that's what I say to clients. I try and step back from it and go, don't overcomplicate it.
Which brings me to the point, I don't know whether you saw, I put out an article late last week and also one in March about the Spider Gold Trust and the fact that in its SEC filings, it's now revealed that it's holding gold at the sub-custodian Bank of England. So Spider Gold Trust has a number of sub-custodians. It normally never uses any of them. All of the gold is supposedly held in the HSBC vault in London. But since April, and so in the first quarter and now into the second quarter, all through May and June, the Spider Gold Trust is holding gold at the Bank of England. We all know that the Bank of England is primarily custodian for central bank gold. Commercial banks have accounts there, primarily or exclusively to allow central banks to lend gold, and so all of that gold is in some way connected to the central bank gold market. So what is the Spider Gold Trust doing, continually holding gold at the Bank of England? What would be your view on that? Is it because it can't find gold anywhere else, and that HSBC has now had to allocate gold at Bank of England, seeing that there's been huge inflows into the GLD?
Well, the first thing to say is we would both like to know the answer, and we never will. So one of the problems we have is that we operate in because we're interested in it for that reason in the area where we don't get to find out. Everything else is knowable. None of this stuff is. But first observation is the Bank of England being the lender of last resort to the LBMA, I think, is meaningful. I find the refusal to return the Venezuelan gold quite amusing in light of what you just said. Yes, I think that the whole EFP saga, the inability of the market to clear, is all to do with the need to keep a lid on ETF usage, in other words, to not allow that to fall over. I think that the only thing that will change that, sadly, other than our very important podcast of revealing the truth, is going to be something quite similar to bunker hunt. So I think it will be very similar. I think it'll be very, life is very cyclical, human behavior is very cyclical, very repeatable. And it will not be a large bank going to the ETF and going, I'm calling your bluff on this. It will be a private individual. It will be someone who has a big enough pocket that will go, this stinks. Those two are right about this. I don't like this anymore. I'm now going to pull your pants down. And that's the moment between now and when that happens. I don't know how long it takes. It will almost certainly take 4 times longer than you and I think, based on track record, or certainly me. I don't know, I'm being rude to you now as well as myself. But I mean, it will take longer because it always does. But I think that we're very close, and I think silver again is the thing. It's always about silver, really, not about gold. For all the reasons you and I understand, it's the one they can't manage. The stocks to flow problem is a huge issue for the banking system, and I think we're there. I think we're there already. It's everything I see is a third of global. It was more than a third of global silver production was offline for 4 months. SLV alone is adding, what is it? 150% of daily global mine supply.
Well, where is it getting these stocks?
Obviously not getting it, is it? I mean, this is the thing. You and I can dance around the subject as much as we like, but it's very obvious that's not happening. I mean, that's not rocket science to say, I think I'm going to say BS on that one. It's not happening. And the question is more, Ronan, so when, and the answer is it will take a while, because people are very believing, and they are. And it takes someone rich enough to call the bluff who doesn't have cross relationships, rather like our friend Mr. Buffett, who only gets called out by you and I, seemingly no one else does it. Well, is it really in my interest to pull on this thread? Well, if you're a sovereign individual and you're wealthy and you're trying to protect your wealth, like the Hunt brothers were, they were just stupid. All they did is they just got it wrong. They got the trade wrong. They didn't understand the importance of it. In my view, I'm not saying I know them, but I'm pretty sure that looking at it, that was a unilateral decision, probably driven by a broker. They say Drexel advised them on, and they went, great, let's try that. But of course, they used margin and they got stretched out on the trade. But I feel that silver is very close to showing this up. And the most delicious irony of all is that at the moment, what it looks like is going to make it happen is, and I'm going to be rude here again, the sheep. It's going to be the sheep. It's going to be momentum chasing sheep that blow the banks up. And that is just too delicious. I mean, please make that happen. It's just so funny watching. Because of course, they have no idea they're doing this either. Because, these people pumping SLV, they're naturally creating pressure under the bomb, aren't they? And I'm damn sure that the ETF providers looking at it like, please back off. They don't want them in there at all. But once it's out, now the way markets work, I think it's as good as done, really. I don't know how long it takes to roll out, but I think we're over the line in terms of the sequence of events that are needed for the end game.
Oh, you broke up there a little bit, but it's back. So,
sorry. I'm sure it was just me repeating myself anyway. Right?
So when you were mentioning about all-time highs, there's a question that I'd like your opinion on, because it relates to inflation, it relates to psychological crisis. So we can look at the gold price high of 1980, which was around January 1980, it was around $800. Then back in 2011, August, September, was the high was 1920. And we've seen now the media have jumped on the interest bandwagon when that was breached a few weeks ago. But if you look at inflation-adjusted prices for gold and silver, they're totally different to non-inflation adjusted prices. And it also depends on what inflation adjustment you use. So for example, if you use the CPI, the current gold price is still slightly below the 2011 high, and also below the 1980 high. But if you use a different inflation adjustment, like John Williams' shadow stats inflation measurement, which for anyone who doesn't know about it, is estimating that inflation over the last 40 years has been far higher than the CPI says. So when you make those adjustments, the inflation adjusted high for gold is something like 18,000 if you use shadow stats. So some media commentators would say, well, that shows that gold is not a good store of value. But the other way of looking at it is that the bull market is only getting started. Oh, yeah. So what's your view on inflation-adjusted highs? And should people be looking at inflation-adjusted highs rather than just the historical print highs?
Well, so I think it's a narrative tool, first thing is what I would say. So it's more important as a narrative tool than it is as anything else. So I would say that, bearing in mind that physical gold is just a risk-free instrument. It's not even an investment, it's disinvesting. So, I immediately would say, well, hold on, we're thinking about it upside down. So, it's a narrative tool, which is very important, and I've started using it lately. In other words, I have not brought this up myself that much over the last few years, because the whole thing was difficult enough to sell without going there on that one. I have brought up shadow stats a lot, and I use that discussion point. I pitch it differently, though. Is what I say is, look, if the bond market is telling you that $1 held in AAA corporate bonds for 7 to 10 years will net of inflation expectations and rates expectations be worth $1, what do you think the real number is? So in other words, what I do is I say to them, look, that's remarkable. I mean, there can't be a single person that actually thinks that's true, yet that's the total collective view of the global bond market. And it's informed by what you said, which is not ill-conceived at all, very carefully conceived misrepresentation of the true cost of living. But I think that there's a difficulty because in a way it's better for us to just talk about, oh yeah, the high was 2000 and we're now, you and I know it's more like 10. But I mean, for some people that's an interesting narrative and they want to hear it, and other people they'll be just confused. Then they're like, I don't know, you confused me again, I'm out. They want to see it's gone through 2000 and it's going to infinity. They don't want to hear about it was 10 or that silver was 800 or whatever. They don't want to hear about this. Some do, and generally it's the more sophisticated investor that I bring this up with. I think that for your people listening to this, the thing I would press you to do, which both Ronan and I have done, is go onto the Shadow Stats website.com and download and read the primer on John Williams' methodology. It's free, it's on there, it's not that long. It actually reads quite well for what looks like an unbelievably boring document. It actually isn't. It's really it's amusing to read it because there's the political context for why inflation was changed and who did it and all the backgrounds, not just the truth, which is the gold and silver measure loss of purchasing power, and the loss of purchasing power is averaged 7-8% per year for 40 years, which of course is why we get populism. But it's he's very methodical about just showing you, well, this is how it all came about, and this is why I do what I do. So above anything else, just get hold of that bit of paperwork, because if anybody else wants to go and talk about this, you probably need the background in order to be able to talk in an informed way about why the inflation data is a load of rubbish, which of course it is.
Yeah, well, I'll have to download that myself. I think we've only got a few minutes left, so I was going to ask you about, I saw you, the first time I ever saw you was at a presentation of GATA in London in 2011 in the Savoy Hotel, and it was a very interesting conference, and I remember seeing James Turk, Jim Sinclair, Jim Rickards, all the James. And with gold now going back above $2,000, I noticed that James Sinclair hasn't been active. He hasn't been making any announcements, and it's a pity in a way because I always loved reading his stuff. Do you think that when James Sinclair made predictions, even 16 years ago, the fact that gold would be part of a reset of the international system, and it's the only way that the central banks of the world can balance their balance sheets, he seemed to be very perceptive about what was in store. I remember one quote from him was saying that when the populations when there will be a time where there's so much turmoil that the world populations will be pleading with the central banks to fix the situation. Do you think that 2020 is now the beginning of this chaos and they're going to create order out of chaos, and that it's been a deliberate ploy to implode the system so as to resurrect it again?
Well, yes, obviously, yes, I do. I think all of those things, but I don't think them. I know that's true. And the reason why I say that again with such conviction and force is because you and I both understand something which a lot of people don't know, which is knowledge, which is that there is occulted knowledge. There always has been for thousands of years. Human beings have been moved around based on what's lit, what is exoteric. Exoteric means meant to be known and understood by the plebs. I think it might even use that word, basically, saying like, so for you lot. And then esoteric, meant to be known or understand to a select cadre of people. And I'm afraid reality is like that. And yes, they are doing this. And why wouldn't they? Remember that the state, all we're really living through is a state power grab, as you and I understand very well. And the best way to do that is through a Hegelian dialectic style problem, reaction, solution outcome. So, you hold gold as a zero risk instrument on your balance sheet as a central bank because it will consume the debt obligation on the other side of the ledger. No issue, not worried about it at all. It will all implode, it will all go back in here and off we go again. So long as they have more control at the other end of it, then mission accomplished. Does that involve gold being reintegrated? In my opinion, absolutely. Of course. It's a cyclical phenomenon, and I wouldn't choose to say it's different this time, which I think you would have to if you were going to say it wasn't the case. So yes, I do think that's happening. I think people need to wake up and smell the coffee pretty quick. But fortunately, people can be in a bit, as in, they can own a fund like the one I manage, or an index of gold miners, or whatever it might be, and they can have 1 foot in our camp as a hedge. They don't have to be, all in. And, that's why I do what I do. I want to get out there and make people understand these things and realize that, yes, there is an inevitable cyclical, not component, a central driver to all of this. And it's becoming increasingly apparent, hence why people like you and I are now, well, we were shoved under the stairs, I suppose, for about 10 years, hidden away like Harry Potter. We're now being invited out to discuss, things with the adults.
Well, Ned, it's always great to talk to you, and I think we're in for a few exciting months for the remainder of 2020. And I hope that the integration of the Marion Fund into Jupiter goes well, and that all of your colleagues will appreciate your very expert knowledge on gold and silver. And so thanks very much for joining our discussion of BullionStar perspectives today.
Not at all, Ronan. We should do it more often.
Definitely.
Let's see where we are in a few months. Let's get back to it.
Oh, definitely before Christmas. It would be nice to catch up again on a discussion before Christmas.
Terrific.
Okay.